Gentleman from Texas, Mr. Neugebauer.
Thank you, Mr. Secretary. Appreciate you being here. You know, one of the things I'm a strong proponent of making sure that these entities were adequately capitalized, and I believe that part of the problems that we faced where we did have some entities that didn't have the capital to sufficiently cover the risks that they were taking. And as I read about the agreement that was reached, I see a couple of things there. One is that we're going to increase the capital requirements across the board, and then we're going to increase also our more clearly define what capital counts towards meeting those goals. But there is a point out there with capital, and what you're going to do with those entities is you're going to raise the cost of capital for them in many ways. And so across the board, you're going to have all these entities out looking for additional capital. It's going to raise the cost of capital. And so in order to be able to continue to generate the returns to the investors in these entities, obviously there's going to be huge pressure on them to increase their income or their revenue streams. And so one of the questions that kind of pops into my mind is there a point there where we put so much restraint and capital requirements there that we actually increase or encourage riskier behavior in order to meet the returns and to pay for this capital? And so how do you balance that?
Excellent question, and it's a thing worth worrying about. I think the architects of this were very careful to take that into consideration, and maybe this is one way to explain how it does that, which is to say that if you take more risk, you have to hold more capital against that risk. Now, if you, again, look at the mistakes made prior to this crisis, you could say that people were able to hold on to all sorts of assets that they thought were risk-free that actually had a lot of risk in it. And that was a costly failure. So by raising the risk you have to hold against the complex, inherently much more risky activities, you reduce exactly the incentive problem that you described. Now, you know, capital doesn't solve all problems. You have to make sure that you have a risk management system, you have a set of internal controls, you have tough supervisors looking over this stuff to make sure that people can't get around these constraints and evade them. And you have to be careful about going too far, because if you get these capital requirements too high, then you will raise the cost of credit unnecessarily, and you will encourage people to move their risk outside of the banking system again, and that would not create a more stable system. So you have to get a balance right, and I think this is a very strong agreement and has a much better balance than we had before the crisis.
One of the questions, though, that, and you make a point, is that one of the key parts of that then is the regulatory structure and making sure that the risks are being identified and recognized. But the question I have is let's take a Bank A in the U.S., and they've got a 7% capital requirement that they're meeting, and then we've got a bank in another country that says, well, we're meeting the 7%. But their regulatory structure may not be as rigorous as the U.S. regulatory structure, and so in fact that bank is able to engage and leverage their risk in a different way than the U.S. bank is. How do we protect the markets in that way?
We are very worried about that for the obvious reasons you are. And if you again look at what the system was like before the crisis, there was very, very substantial scope for countries to let their banks run with much lower capital than our banks were forced to run with. The required minimums were lower. They could count all other count sorts of stuff as capital that we didn't allow people to count. And in addition, we don't think they were as tough on how they accounted for risk as our supervisors are. And I know that if you look at the mistakes we made in the United States, it's hard to understand this, but in fact, the requirements we had in place for our banks were substantially tougher than was true for banks in many of the major economies around the world. So what this agreement does is substantially narrow the capacity for countries to have their system run with lower standards, because it's much tighter definitions of what counts as capital, much tougher risk weights on risky assets, and a higher overall minimum standard. And I think the combination of things give us much more confidence that it'll be applied evenly. It's not enough, though, and we got a lot of work to do, as I said in my remarks, to make sure that as the regime is operating, we don't let too much discretion seep back into the system that would put us at a competitive disadvantage. The provisions in the bill give us a strong hand, and we're going to make the whole system much more transparent, so there'll be a good market test all the time about how much capital these guys are actually allowed to run with. And we're going to be and have to be very careful monitor very carefully and pursue much more aggressively any signs of differential standards.
So will there be specific risk premiums, a prescriptive way on certain types of assets that everybody across the spectrum will be required to use in analyzing the amount of capital and the risk in that portfolio of assets?
It's not quite that. And there's risk in that approach too, because then if you do that, if you have the government just sit there and prescribe the risk weights, then there's a real risk people can just get around that, arbitrage around that, and leave the system more risky. What this does is make sure there's a common framework you have to use for how you measure risk. And that basic framework has to be common across countries. It's not perfect. There's still a lot of risk. People will operate it with different degrees of rigor, which is why we're going to have to be on this for a sustained period of time. But we have a much better chance now that we'll be able to watch this stuff on a quarterly basis and see where firms who compete against each other are operating with different actual standards of leverage.
Gentleman from North Carolina.